Yeah. I put new batteries in my remote, and I'm thinking maybe that's what's been causing the problems I've been having with this thing the whole time. Maybe the batteries are just low. So we'll just see. We'll see if that theory holds up or not. Okay. So again, accounting for receivables. So these are the concepts we're going to review this chapter. We already know what the revenue recognition principle is, so we will refresh our memories on that and think about, in an account receivable situation, you've made a sale, right? And hopefully that customer is going to pay you because they didn't pay you at the time of purchase. And usually customers do, but there are some customers that never pay you. And that becomes an expense. Some of you mentioned it earlier, a bad debt expense. So that gets a little tricky then, because you need to estimate how much bad debt you think you're going to have in that same period when you made the sales. But you don't really know how much bad debt it's going to be until later. And so that's why this revenue recognition principle comes into effect, because you made the sale maybe this month, and then maybe it's 6 months later before you finally realize, hey, this customer is never going to pay me. Right? And then you realize you've got an uncollectible account, which ties into the expense recognition principle. You can't wait 6 months to count that expense. And that's why we have to estimate it during the period of the sale. Any estimates for uncollectible accounts are going to impact both the balance sheet and the income statement. But they're estimates, which means that they're not necessarily correct, right? In fact, they're probably not. So we'll learn how to deal with that and how you could actually use that to your benefit. There are ways you can use that process of estimating your bad debt to either make your company look more profitable or pay less in taxes for your income taxes. And that might not sound like it's legit, but you are allowed to do that within GAAP. So we'll talk about what is allowed and what isn't allowed. That's the difference between earnings management and earnings manipulation. So we'll cover that. We'll look at ways to measure your account receivables, a couple different ratios that we'll use to see how good is your company at managing account receivables. We'll look at how this applies if you've got a long-term project where your customer is not going to be paying you for months or maybe even years. When do you count the revenue in those cases? We'll look at how notes receivable differ from accounts receivable. I skipped over what are called the balance sheet method and the income statement method. These are different approaches we can use to estimate our bad debt, so we'll go over that. And then we are going to go through a comprehensive example of bad debt. So start to finish, you can see what the whole process looks like, from estimating to actually experiencing the bad debt and then adjusting your accounting records. So there's a lot to learn in relation to accounts receivable. All right. Again, the revenue recognition principle, right? We're familiar with it. How would you explain it to somebody who doesn't know anything about accounting? What's the revenue recognition principle? When do we count revenue? Customer pays us? Or actually not? When do we count revenue?
Whenever you charge us or whenever they buy it.
Correct. When we provide the product or the service, right? That's when we can count it as a sale. If we were doing the cash basis of accounting, then it is when we get paid, but we're not, right? We're mostly working with the accrual method, and in the accrual method, you only count a sale when you provide either the product or the service to the customer, and it doesn't matter if they paid you, it's a sale. In fact, these are the 4 steps that are required to count a sale. So there has to be an arrangement between the 2 parties. You can't just provide a product to somebody who didn't want it and say, I made a sale. Because they didn't want the product, right? And they haven't promised to pay you. So there has to be an arrangement that they want the product and you will be paid. You do have to deliver the product or the service, as I mentioned. There has to be an established cost that the customer is going to pay, price, right? You can't say, hey, I made a sale, but I don't know what the amount was. Well, then it wasn't really a sale, right? And you have to be able to assume that you can collect the money, right? So if there's a toddler and you say, hey, I'm going to sell you this, bag of candy for $5. Here's the candy. And they don't have any money. You didn't really make a sale, right? You just gave away some inventory. So these are the 4 things that technically have to be in place for there to be a sale. And then, as I mentioned, the expense recognition principle goes along with the revenue recognition principle. That's why it's called the matching principle. And what does the expense recognition tell us about when we can count an expense that's related to a sale?
Whenever it's incurred.
Yes. Yes. But there's more to it than that. So we have to have incurred the expense, but there has to be a sale, right? So, for example, think about the income statement. You start with the revenue, and then the next thing under revenue is your cost of goods sold. All the costs that went into making the product that you sold. And it's not cost of goods manufactured, right? Because there might be some goods we manufactured, but we didn't sell. We can't count the cost of those goods until we sell them. That's the expense recognition principle. Now, selling and administrative expenses are not directly tied always to specific products. So really, it relates to the production costs. Cost of producing your product, you can only count as an expense once you sell the product. And that's the expense recognition principle. But yeah, you do have to have incurred the expense, but you also have to have the revenue to attach it to. All right, so that's just sort of review. Here we have an example. This is going to be review as well. A company sells a product to a customer. We can see the company's journal entry from when they made the sale. So you can see that they counted the sales revenue and the customer has not paid. So that's why there's an account receivable. The company uses the perpetual inventory method because we can see they've identified the cost of the goods that they sold and they've reduced their inventory. And that is our typical sales journal entry, right? And then the customer pays at some point. So that account receivable gets credited and the company receives cash. So cash gets a debit, right? We've seen this kind of transaction before. Now, what if the customer, instead of promising to pay and having an account receivable, they pay with a credit card? Well, there are 2 ways to handle that. The first way is that credit card becomes the account receivable. So the company is saying, okay, we'll accept your form of payment, and then we're going to record in our records that there's now an account receivable from the credit card company. So we can check and make sure that they pay us. So otherwise, it's pretty similar to the sale that we just saw, but the one other difference, there's this credit card expense. Because the credit card company is trying to make a profit too, right? They don't charge the customer unless the customer doesn't pay their bill on time, and then they may get interest and fees. But just for making the purchase, they don't charge the customer, they charge the merchant, the seller. and it's a predetermined interest rate. So in this case, the seller is paying $15 for the privilege of being able to accept that Visa payment. That's why some merchants don't take credit card, because they don't want to have to pay the fees. These days, there are some pretty inexpensive credit card processors out there. So that's why it's pretty common now. Most merchants do. They even make it easy. You could even process credit card payments on your cell phone. But still, there is an expense, and the merchant ends up paying that expense. So this is how you would journalize it. Now, the sale was $300. And 5% of that would be $15, right? So that's what the credit card company is charging in this case. They're charging 5% to the merchant. So 5% of the $300 sale is $15. And the merchant goes ahead and just counts that as a credit card expense. They don't have to send the money to the credit card company. They are just going to send less money, because they're going to subtract that $15 from the amount of the sale, and all that they're going to collect from the credit card company is the difference, $285. So this is one way to process credit card transactions. It's probably the more common way, because this method lets you keep track of whether or not you got paid by the credit card company. Of course, when they pay, then you would just go ahead and remove their account receivable with the credit and debit the cash. But this is the other way that they could do it if they wanted to save themselves a step. They could take the credit card payment, go ahead and count the $300 sale, count the $15 credit card expense. But in this case, they didn't use an account receivable. They just indicated they got $285 in cash. Now, they didn't actually get the cash, right? When they accept the credit card payment, it usually takes a couple days before the credit card company deposits the money into the company's account. When you get set up to be able to accept credit card payments, you have to provide your bank account information, and you have technically what's called a merchant account. I don't think that shows up in the textbook. But that merchant account is where the credit card company is going to deposit the money that they owe you, which goes into your bank account. And that process typically takes a couple days. So they really didn't get cash, but what they're saying in this case is, you know what, we know we're going to get the money within a couple days, we're just going to treat it like cash. And then that way we don't have to count it as an account receivable and then go back and update our records. Of course, what if you don't get the deposit? What if it turns out to be a bogus credit card, or the customer calls back and says, I didn't really make that transaction, and you never get the money? And you're going to have to go back in and figure out what happened, adjust your records. So I would typically recommend not using this approach, even though it's a little bit easier. And in fact, as we go through the exercises and problems, for the most part, we're using the other method, where you do count the credit card payment as an account receivable, and then when it's been received, you go ahead and clear it out. So any questions on credit card payments? I would journalize those. Okay. Oh, well, we have an exercise, so good, we can practice. Prepare journal entries for the following transactions. Okay. I'm gonna pause here, the recording. If I forget to start the recording later. All right, nobody reminded me to start my recording earlier. That's okay. Didn't miss anything too critical. So, what would the credit card payment journal entry look like? What would we debit And what would we credit? Go ahead, Danielle.
First step it would be to accounts receivable.
Okay. Oh, that a little bigger. Accounts receivable for the credit card company, right? And then what next?
Then also debit the credit card expense.
Credit card expense, great. And then what?
And credit the sales revenue.
Sales revenue. All right, you're on a roll. Keep going. What would we debit next? Well-
We could also debit accounts receivable.
Well, nope. So think about the inventory. We have to account for the inventory, cost of goods sold. I knew you knew. And the last one,
Merchandise inventory.
merchandise. Great. Okay, so that's what everybody should have had. Any questions? Joanne?
Will the cost of goods sold increase by the credit card fee as well? Or no?
No, because it's not considered a cost of the actual goods. It's an administrative expense. Yeah, good question though. Okay, so now what would be different for the third transaction? Compared to the one we just did with the credit card payment? What's different if it's a cash payment?
The credit card expense?
No credit card expense, that is correct. And there's one other difference. That did not work. What's the other difference?
Maybe cash.
Yeah, exactly. Jacob, right? Exactly. So then it would look like that. It's not that hard. All right, any questions out there? Okay, well, let's proceed then. As I mentioned earlier, sometimes customers who promise to pay you don't pay you for whatever reason, right? Could be intentional, maybe not. But you have to realize that that's a possibility. So when that happens, it's bad debt. But as I mentioned, we need to estimate that during the period in which the sales are made, or actually, typically, the way it's going to work in this chapter is we would be estimating it for the entire year. So we would look and see how much credit sales did we make for the whole year. In other words, what's the total amount we sold to customers where they didn't pay us? And the technical name for that is our net credit sales. So then out of the net credit sales, we'd have to estimate what percentage of that do we think is not going to get paid. There's a couple alternative ways we could do it. We could base it on the accounts receivable as well, take a percentage of that. But either way, we're making an estimate of what the uncollectible amount's going to be. The way we would do that is we would look back at previous years and see, oh, in the past, 2% of our net credit sales didn't get paid, or 4% of our accounts receivable didn't get paid. And then we would use that to estimate this year. So we could go ahead and count that bad debt expense this year, even though it's just an estimate. Because maybe some of those customers will pay us, or maybe our percentage is even low, and that means even more customers won't be paying us than we estimated. So when we do this, whatever amount we estimate for bad debt reduces our net accounts receivable. So in other words, let's say we sold $1 million of stuff on credit. So our customers owe us $1 million, but we think that 5% of that's never going to get paid. So then our net accounts receivable is $1 million minus that 5% that we don't think we're going to collect. And it also impacts our net income. Because if we have bad debt expense, remember expense shows up on the income statement, right? So the more expense we have, the lower our net income. So there are a couple different ways that this can be done. Now, the first method here is not GAAP compliant. It's called the direct write-off method. In that approach, you don't estimate your bad debt. You just wait to see which customers don't pay you, and then you count it as bad debt at that time. But that violates the expense recognition principle. Remember, you have to count your expense in the same period as the revenue. In other words, let's say you make a sale to a customer this year. And you count that revenue for this year, obviously. And then they're supposed to pay you. You wait till the following year, they still haven't paid you, and then you count it as bad debt. Well, that violates GAAP because the revenue was last year and you're counting the expense in this year, which is why we need to estimate it. So that direct write-off method of waiting until they don't pay you and then deciding it's bad debt, we're not going to do that because it's not GAAP compliant. Instead, there's what's called the allowance method. There are a couple different variations on that we will see. They're pretty simple. One of them involves looking at how past due your customers are. So you would say, okay, how many customers are 1 month past due? How many customers are 2 months past due? And it's a little bit more involved, but you get a more accurate percentage with that approach. So I'll explain that when we get to it. So that's really what this whole chapter is about. So that's the main thing, is how do we estimate this bad debt as accurately as possible so that then our accounts receivable will be accurate, our net income will be accurate. So, okay, I already said this. Let's get that. All right, so the allowance method that is an acceptable approach through GAAP has two basic variations. There's the income statement approach and the balance sheet approach. They're pretty simple. With the income statement approach, you're basing your estimate on net credit sales, which is on the income statement, right? Because the income statement starts with revenue, sales. On the other hand, the balance sheet approach is based on your accounts receivable, which does not show up on the income statement, it shows up on the balance sheet. Okay? And that's really the difference. It's pretty simple. Either way, whichever approach you use, the journal entry is going to look the same. At the time you estimate your bad debt, that's when you take your bad debt expense. You know, all the expenses that we can count, right, that we can journalize, reduce our profits, which means we pay less income tax. So you debit bad debt expense, and then you credit this account allowance for doubtful accounts. Remember that what is allowed is the allowance method. That's what we're doing here. We're saying we've estimated that a certain amount of money is not going to get paid to us by our customers. Now we created this allowance account where we're going to keep track and figure out how close we were to our estimate. And then if we need to, we can make adjustments later. We'll learn about that as well. Are there any questions so far? All right. So, oh, here we go. The allowance for doubtful accounts is a contra asset account. Remember, we came across that before with depreciation. Remember when you take a depreciation expense? You have an expense, and then you have accumulated depreciation as the contra asset account, because however much depreciation you've accumulated reduces the value of your asset. Well, it's the same thing here. The more bad debt expense we have, that accumulates in this allowance for doubtful accounts. And then that reduces the value of our accounts receivable, because we're saying, again, our customers owe us $1 million, $50,000 we think we're never going to collect, so our net accounts receivable has been reduced. Okay, so it's a contra asset account. Here we see that whatever our gross accounts receivable is, the total amount that our customers owed us, when we subtract how much we think we're not going to get paid, the difference is our net accounts receivable. Right? So we go from gross to net. Any questions? All right. Okay, this might be the trickiest part. It seems like every chapter has a tricky part, right? I think this might be the trickiest part of this chapter. If you take notes, it's not that hard. When you're using the balance sheet method, so if you're basing your estimate on your accounts receivable, taking a certain percentage of your accounts receivable, estimate your bad debt. If you had a previous balance in that allowance for doubtful accounts, then you either need to subtract or add that previous balance, depending on whether it was a credit or a debit. So that might be a little hard to remember or even to understand. So if you just kind of write it down, then that should help. What is this example? If there's a credit balance in allowance for doubtful accounts, then you're going to subtract it from your new estimate. So where it says current period, that is your new estimate for bad debt. You're going to subtract that credit balance, and the difference is what you're going to record to allowance for doubtful accounts. Now, if you want to understand why, maybe you don't want to understand why, I don't know. But it helps me to understand why. So I'll explain it and we'll see if it helps. When we record bad debt, we credit that amount to allowance for doubtful accounts, right? And we learned that that's a contra asset account. So whenever it increases, we credit it. So then once the period goes by and we find out the actual bad debt, we think, so I don't mess this up, if we didn't use up the entire allowance, then we've got some credit remaining in allowance for doubtful accounts. And that's the case here. We didn't use up all of the bad debt we thought we were going to have for last period. So to get up to the new estimate of 2,500, we only need to add 1,500 because we already have $1,000 credit sitting in that account. Now, on the other hand, what if our bad debt estimate had been too low? What if we actually had more bad debt, actual bad debt, than we had estimated? Then we would end up with a debit balance and accumulated allowance for doubtful accounts, sorry. We would have a debit balance and allowance for doubtful accounts. And in that case, whatever is the new amount that we're estimating, we would need to add the amount that is currently there, and we would need to credit the combined amount. I know that's a lot to try to grasp. It's taken me a couple years to try to understand how that works, and I still have to think about it. So the easy thing to remember, okay, if you want to just take a note and make it easy, when you're using the balance sheet method, and there is a credit balance in allowance for doubtful accounts, you subtract it. there's a debit balance and allowance for doubtful accounts, you add it. Credit, you subtract. Debit, you add. Okay, so if it doesn't make any sense to you, if you can just remember that, that'll help you, because I think there is going to be a problem that you'll have to solve along those lines. So you see in this case, they estimated the bad debt to be 2,500 for the coming year, or I guess that would be for the current year. But they already had $1,000 extra bad debt that they hadn't anticipated previously. So then we need to credit the combined amount to get up to the 3,500. Right? Because if there were $1,000 debit balance and you wanted to get it up to a $2,500 credit, you'd have to credit $3,500 to offset the existing debit balance and then get up to the credit that you want. Okay, again, doesn't make sense, that's okay. As long as you know, subtract when it's a credit, add when it's a debit. All right, any questions on that? Right. Is this an example? Oh, okay, no, this is something different. Now, remember, we're estimating what our bad debt's going to be. And we don't know which customers are not going to pay us. If we knew for sure a customer wasn't going to pay us, we would have made them pay cash, right? We wouldn't sell them something on credit if we knew they weren't going to pay. So we do our estimate based on the total amount we think we're not going to get paid. But then when we find that there's a specific customer that we've given up on, we said, okay, this person's just never going to pay us. Then we debit allowance for doubtful accounts. Okay, we're saying we're going to use part of that allowance for this customer because, hey, they're just not going to pay us. And then we go ahead and we credit their account receivable. That gets it off the books. Now they don't owe us anything anymore. We went ahead and just counted it as part of our bad debt. We could still sue them or maybe, send a collection agency after them or something like that. But at this point on our books, we've already said, okay, they don't owe us anything anymore. We'll just debit the allowance for doubtful accounts. Does that make sense? But then what if something happens? They decide to pay us. Okay. Well, then the first thing we have to do is we have to reverse that last transaction. So you see how this is the exact opposite of when we wrote off their bad debt. Just do the opposite. So now we restore their account receivable and we credit allowance for doubtful accounts. And then we process their payment. When we process the payment, we debit cash and credit their account receivable. Does that seem a little redundant? We just, in the same transaction here, we're debiting their account receivable and then we're crediting their account receivable. Why would we do that? Why that extra work? Thoughts? Because we could just debit cash and credit allowance for doubtful accounts. It might be a little unclear why we did that, right? So this makes it super clear. We reversed the writing off of their bad debt, and then we processed their payment. Little extra, work, but it provides a clear paper trail of exactly what happened. And it comes out the same. The customer paid off their debt, so they don't owe us anything. Any questions here on the process of writing off a customer's bad debt or reversing that? All right, so the income statement method is based on, where is it? a percentage of sales. Specifically, net credit sales. So as I mentioned earlier, we look at what were our net credit sales for the period. What percentage of that do we think we're not going to collect? And then that's how we estimate the bad debt. Now, where do you think we come up with that percentage? How do we figure out what percentage of the net credit sales we think are not going to pay us? Pick a number. Throw a dart at a dartboard and see what number it hits. How would we come up with the number?
How many customers actually pay?
Okay, from
The
prior period? Yeah, we can look at in the past, what percentage of our net credit sales never paid us? So we still don't know for this period, right? We're still in this period. We would typically do this at the end of the year, but there's some customers that might have just made purchases within the last few months, and maybe we're still in the process of paying us. So if we look at last year, then that would give us a better idea. Or at least we could look at previous quarters. So let's see what's going on here. I don't remember what this is. Oh yeah, so here, this company is using the income statement method, which all that means is they're basing their estimated bad debt on a percentage of net credit sales, which are from the income statement. Okay, and they are saying 5% of their net credit sales are bad debt. All they have to do is take their net credit sales for the year, multiply that by 5%. They write that off as a bad debt expense and credit the same amount to allowance for doubtful accounts. Pretty simple. That's all you have to do if you're using the income statement method. Then when a specific customer you feel is not going to pay you, that's when we write off that customer's account. Again, we debit allowance for doubtful accounts, credit their account receivable for that customer, so it shows they don't owe us anything anymore. Then again, if they do make a payment to us, we have to reverse that write-off. So that's the opposite of the last transaction. And then we go ahead and process their payment and again, wipe out their account receivable. So it's just like the example we saw earlier. Now, if they're using the balance sheet method, instead of net credit sales, we are estimating a percentage of accounts receivable. So we take that percentage, multiply it by the account receivable that we had, and we journalize it the same way. We debit bad debt expense, credit allowance for doubtful accounts. Remember though, with the balance sheet method, we also have to think, was there a prior balance in allowance for doubtful accounts? In this case, there was not. It was a zero balance. But if there were, it would be either a credit balance or debit balance. So let's check either your memory or your note-taking abilities. If there had been a credit balance and allowance for doubtful accounts, we're using the balance sheet method, do we add or subtract?
Subtract.
Correct. And if there was a debit balance, in that case, we add. Good job, Jordan. All right. So here again, we see if there's a credit balance, we subtract it from our new estimate, and we credit the difference. That's why the bad debt is this amount, the difference. Any questions so far? Okay. Now there's a variation on the balance sheet method, which again is based on accounts receivable. This variation is the aging method, where we're not just looking at our total accounts receivable, but we're looking at how old our accounts receivables are. So in this case, they have divided the accounts receivable into 3 different categories. The company says, let's look at how many customers are up to 30 days past the due date. And let's look at the customers who are 31 to 90 days past the due date, and then the customers that are more than 90 days. And the reason they might break it down into these categories is the older the debt gets, typically the less likely you are to collect it. So if they look back at their records, they see that in this first 30 days past due, customers owe them this much money, and typically 10% of those customers don't pay. If they look at the next bracket here, they see how much money is owed to them by customers that are 31 to 90 days past due. And typically 20% of those customers don't pay. And then in the 90-day bracket, they see how much is sitting out there uncollected. Typically 30% of those customers don't pay. And again, the percentages would come from previous periods. We look at previous years and see how many customers didn't pay you. Then all you do is you take the amount that's owed to you in each of these categories, multiply it by the percentage, that gives you a total, and then you add them all up. And that becomes your total estimated bad debt. So it's more work because you have to come up with these different categories, research how much is in each of those categories, what percent you think aren't going to pay you, and then do your calculations. Why do you think it would be worth it to do this extra work? Instead of just taking your total accounts receivable and multiplying by 1%, why go through all these extra steps? I'll give you two reasons. One is it's probably more accurate. Your total that you're coming up with is probably more accurate because if you just take the total accounts receivable, you don't know how much of that is a little bit past due and how much of it is way past due, right? Because you're just looking at the total. So the percentage might not be as accurate as when you break it down into these different categories. But the other thing is if you've got a collections department, and a lot of companies do, they want to know this information, right? They want to know which accounts they should focus on to try to collect the money. These are going to be the easiest ones. Just happened to me the other day. I made a mistake in setting up my automatic payments. I put the wrong amount for a company that I make monthly payments to. Sent me a nice little email saying, you underpaid us this month. I was like, oh, shoot. So I went in and I paid the extra money. So somebody who's 0 to 30 days past due, it might be something simple like that. Check got lost in mail, or they forgot to make a payment or something, and it's easy to collect from them. If somebody's already 90 days past due, there's a good chance they're not going to pay you. You might need to get a little more assertive in collecting from them. You might need to call them more frequently or email them or whatever it is. You might even need to put your more assertive collection representative on the phone with them. You know, let them know, hey, we're about to report this to your credit agency, or we're about to take you to court if you don't pay us. Right? These are the customers that are going to be harder to collect from. So that's helpful for your collections department, even for your finance department or the accounting department that's trying to estimate cash flow. All would benefit from having this breakdown. Okay, so the methods we have are the income statement method, balance sheet method, and the aging method. And it's called aging because we look at how old the past due account receivables are. All right, questions or comments? All right. Again, we journalize it the same way. Whatever is the total estimate of bad debt, we debit bad debt expense, we credit allowance for doubtful accounts. So it doesn't matter which of the three methods you're using, income statement, balance sheet, or aging. Once you come up with your amount, You always journalize it the same way. All right, so here there was a previous debit balance and allowance for doubtful accounts. As we know, there's a previous debit balance and you're using the balance sheet method. You need to add your new estimate to that existing debit to get the total amount, and that's your bad debt expense. Okay. All right, oh good, we have some practice here. So the first thing, A, it says compute bad debt estimation using the income statement method and 5%. How would we do that? How would we figure out our bad debt estimate using the income statement method? Pretty simple. What do we have to do? What do we multiply by what? You're close, 5%, but if we're doing the income statement method, it's not going to be accounts receivable, so net credit sales. That's all we do. Net credit sales times 5%. Then journal entry. Well, the journal entry is going to look like this: debit to bad debt expense, credit to allowance for doubtful accounts. That's pretty easy. If we're using the balance sheet method with 9%, that's where we're going to use accounts receivable. In this case, there's zero balance and allowance for doubtful accounts, so we don't have to worry about adding or subtracting. All we would do is take 9% times the accounts receivable. Then we journalize it the same way. Debit bad debt expense, credit allowance for doubtful accounts. Okay? Exercise 13, let's do that. Okay, so you're the accountant for a large publicly traded company. You're considering whether or not you need to change your bad debt estimation method. You're currently using the income statement method, right? And the income statement method is based on net credit sales. Okay, you're considering switching to the aging method. Now, the aging method is the one where you look at your accounts receivable, but also how old they are, right? So it's more work because you have to break it down into categories, come up with multiple percentages, right? And come up with a total. So that aging method is more accurate. It allows you more precisely to estimate what your bad debt's going to be, but it takes more time. So the question is, do you have a, let's say, legal responsibility to use the aging method and have a more accurate estimate of your bad debts, so your financial statements will be more accurate? Are you legally required to do that, even though it's going to take you more time to use the aging method? You're right. No. GAAP allows us the discretion to use whichever method we want to use. In theory, you should use the one that's the most accurate, but if you don't have the time, you could use one of the easier methods, balance sheet or income statement. That is the correct answer. All right. Oh, ratios. Okay. Ratios, I find, are always a little refreshing because they're pretty simple. So ratios, as I've told you before, they're useful by various stakeholder groups because they take multiple pieces of information and they simplify them down. So that's why investors and other stakeholder groups, they really like ratios because they're just easier to understand. So we have some ratios related to accounts receivable. The first one is the accounts receivable turnover ratio. I'm just gonna refer to it as turnover. Because a lot of these phrases are just too long to keep repeating over and over. So your turnover ratio, it's pretty simple. What you do is, is the formula up there? No, okay. You take your net credit sales and you divide it by your average accounts receivable. Pretty simple thing to do. And that gives you a number, and that is your turnover ratio. A second ratio we have is even easier to calculate. It's the number of days sales and receivables. In other words, how many days worth of your company's credit sales are sitting out there unpaid for? And the way you calculate this is you just take the turnover ratio that you already calculated and divide that into the number 365. That's all you do. Why 365? Because there are 365 days in the year. Except this year because it's leap year, right? But usually 365. So those are the two ratios. Now the turnover ratio, as I mentioned, it's net credit sales divided by average accounts receivable. Pretty simple. But you have to know what your average account receivable is. So the way that that's done, not the most accurate method in the world, but it's acceptable. So this is the way we'll do it. You look at what your beginning accounts receivable is for the period. You add that to your ending account receivable for that period, and you divide it by 2. Now, if you've taken statistics, you know that's not a very good average, right? I mean, if you really wanted an average, you would look at every day accounts receivable balance and add it all up and then divide by the number of days, and that would give you a more accurate average. But here, we're not going to do it that way. It's just beginning plus ending divided by 2. That gives you your average accounts receivable, which is part of this calculation. Then to get your number of days sales and receivables, as I mentioned, you just take 365, divide it by your turnover ratio, and you got that one. All right, so here's some data that we're going to use to practice with. We have 2 financial statements here. We have a balance sheet and we have an income statement, right? Income statement, balance sheet. All the information we need to calculate the ratios is right here. So let's first figure out, for what are we doing, 2018 first? 2017. For 2017, let's figure out our turnover ratio. We go back to the formula. First, we need average accounts receivable for 2017. Okay? Where are we going to find accounts receivable? Income statement or balance sheet? Balance sheet. Thank you, Yvette. That's right. Accounts receivable. It's an asset, right? So it's on the balance sheet. Now, if we want the average accounts receivable for 2017, well, we know what it was at the end of the year because that's when we would have made our balance sheet. You can see the date here tells us it's the end of each year. How would we figure out the balance in accounts receivable at the beginning of 2017? Exactly. Look at the end of 2016, which would be the same as the beginning of 2017. So we're going to take these 2 numbers. That's our beginning and ending account receivable. 70,000 and 90,000. We add them together and divide by 2. And we call that our average accounts receivable. Okay? So again, take this year's ending accounts receivable, the prior year's ending accounts receivable, add them together, divide by 2. In that case, that would give us 80,000, right? That would be the average of those 2. And then we take net credit sales and divide it by that average accounts receivable. So when we do that, see, here's the average accounts receivable. Here's net credit sales divided by the average accounts receivable, and we get a ratio of 5. There we go. Our AR turnover ratio is 5. What that means is that the net credit sales is 5 times as big as our average accounts receivable. So 1, 2, 3, 4, 5. It fits in there 5 times. That's all we have to do. Is this the next year? Yeah, if we did the next year, we get a slightly higher number. So for the next year, we would go, we would look at 2018's ending accounts receivable, add that to the prior year, divide by 2, divide that into net credit sales, and in this case comes to 5.14. Now the higher the number, the better, because a higher number means you have more sales and less accounts receivable. All right, a lower number would be less sales and more accounts receivable. So you want your turnover ratio to be as high as possible. Any questions? Right. Getting close to break, so hang in there a little bit longer. Then you get your number of days sales and receivables. You take 365 and just divide that by the turnover ratio you just calculated. So if we do that for 2017, take 365 divided by 5, 73 days. That means that typically there are 73 days worth of our sales sitting out there unpaid for. And in 2018, we see that that number has gone down. Now, I told you that with the AR turnover ratio, the higher the number, the better, right? But with number of days sales and receivables, you want it to be lower. You want fewer days worth of your sales sitting out there uncollected. But these numbers are inversely correlated. So because we're dividing 365 by the AR turnover ratio, when that AR turnover ratio goes higher, our number of days sales goes lower. So they're automatically going to work that way. Another way to think about that is we want a high AR turnover ratio, and we want a low number of days sales and receivables. All right. Let's take a look at these results. So here the calculations have already been done for us, but we're going to compare one company with their competitor. In 2017, we see the AR turnover ratio for BWW versus the competitor. Which of these is stronger? The 5 or the 4.92? 5. Exactly, because we want a higher number. So you see that in the following year, the competitor is now stronger. Let's look at number of days sales. Which one's better over here? 73 days or 74.19? 73. Again, we want it shorter, right? For number of days sales. So again, BWW is doing better, but then the next year the competitor is doing better. So we can use these ratios not only to see how a company is doing compared to its previous performance, we can see how a company is doing compared to another company, or even compared to the entire industry. If we have stats for that industry, we can then compare and see, is the company doing better than their overall competitors or not? Ooh, which brings us to a problem. Okay. So problem number 8.